Hello again and welcome, and thank you for joining us. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is Tuesday, March 21st of 2023. Let's talk about the three topics we're paying attention to, moving markets, so you should be too. Thanks for watching, and let's get right to it. Our first topic of the day, and it's basically the only topic that the global markets as well as we are paying attention to here in the United States and Blanke Schein Wealth Management specifically, is what the Federal Reserve will do. Will they hike? Will they pause? Or will they pivot? Well, ultimately, the Federal Reserve now is painted into a corner, we believe, where they have to hike by 25 basis points. Right now, if you look at Wall Street futures, it's about an 82% chance that they actually will tomorrow. Simply because it's a crisis of credibility, crisis in the sort of the banking system, the small regional banks. As we saw the last couple of weeks, Federal Reserve had to pull some emergency moves in the U.S. Treasury and as well as FDIC regulators on the smaller banks and match them up with the larger banks. We also saw that with UBS and Credit Suisse over this last weekend. And so markets are up today presently in anticipation of the 25 basis point potential hike that the Federal Reserve will do tomorrow, but it's going to be a dovish hike. If you follow along, if any of my market insights and observations the last year, I've been very specific and very clear. Our clients' capital, we've been moving into treasuries. Basically, you're looking at 4.5, even 5%. It's on the short term of the yield curve, but that also caused sort of the banking and the bond market volatility that we've seen, because if you put your money in a bank, you not only have to worry about the FDIC insurance of anything over $250,000, but you also aren't getting paid, and the banks are using that money to make money on your money. And so we've been taking in substantial deposits from banks and regional banks over this last year, because it's really at the same time, why would you put your money in a bank when they're not going to pay you and they're going to make money on your money? And then you have to worry about ultimately, with FDIC insurance, or bring it over to like a Fidelity or a Schwab, where we're going to put it to work for you, and we're going to put it in U.S. Treasuries, and you're going to make well over 4.5%, or whatever the yield happens to be. Now, that's ultimately the price to pay with regards to what the Federal Reserve raised rates. And this is what I've been saying. They're raising rates. They're causing an imbalance. They're going to raise them until something breaks. Believe it or not, it's 19th time year to date, or year over year, and it could be the 20th tomorrow if they continue. This is the fastest interest rate hike in history in terms of Federal Reserve policy, the quickest that they've ever moved. But they've also seen this before. In 1994, there was an Orange County crisis, bankruptcy, in the muni bond market because the Federal Reserve is raising rates too quickly. And that caused the Fed to break Orange County. The munis had to scramble, bond market volatility, and then they pushed pause on their interest rate hikes. Subsequently, into 1995, in the next 3 or 4 years, the S&P 500 took off well over 25% per year on average those last 3 or 4 years. Then we got to 1998, long-term capital management. That was a hedge fund private equity that blew up. And ultimately, that was a private bailout. We saw a private bailout of a bank earlier this week. So the tools in the bag and the strategies and the experience of regulators actually have seen this and done this before. And back then in 1998, they passed it around to Wall Street and said, listen, we don't want this to be a bigger problem. Pass it around. Everyone throws money in the hat. And they ultimately bailed out. Long-term capital management actually went under. But they've actually stemmed the tide of what could have been a larger crisis. And ultimately that pushed pause on the Fed in 1998. And markets actually performed really well in 98 and 99. So we've seen the S&P 500 actually turn a little bit of a positive note in the last couple of trading sessions, because this could be the pause, potentially pivot after the hike. We believe it's going to be a 25 basis points dovish hike, but after that, the equity markets see through a couple of things. So that's what we're going to be looking for tomorrow. Also, if you look at new home sales today, these are home sales that closed that probably were put in contract in November and December. Remember, interest rates came down to about 6% versus the 6.5% to 7% on your mortgage you can get today. Well, that saw an influx of buyers. Those escrows just closed in February. That February closing just got recorded. In the month of February, we saw a month-over-month increase of a 14.5% spike in sort of home sales because we saw a dip in interest rates. That would be the conclusion. that the markets are making at this point in time. Now, we did see home sales dip for the first time in 120 or 131 consecutive months, which is nearly 11 years. But what everyone's waiting for on the real estate market is a 20% decline, much like 2007, 2008, and 2009. We saw a 0.2% decline month over month in terms of home prices. So yes, home prices are coming down, but at the same time, inventories went from just a few months to now 2.8 months in terms of inventories in the market. Now, what is that saying? What am I ultimately pointing to? There's really not going to be a housing crisis, we believe, in the United States. There'll be some pockets, some people, some investors that are over leveraged or potentially needs to sell for some reason. But for the most part, we don't see a 20% decline in property values potentially moving forward, simply because most people don't need to move. If you've got a 3% mortgage, why would you trade up to a new home at a 6% mortgage? Number one. Number two, financially, the balance sheets of Americans, as well as the banks, believe it or not, the large banks are financially sound. So this is not a repeat of 2007, 2008, 2009. And ultimately, we are in a housing shortage. We need 2.6 million homes every year just to meet the demand of the Gen Xers and younger generations coming online buying homes. Obviously, affordability is slowing things down a little bit, but not by much, because we're only producing 1.6 million new homes. So if the existing home, if you're sitting there with a new nice mortgage, you don't need to sell, you don't need to move, you don't need to relocate, you don't want higher prices or higher market affordability for a home, those homes are going to be shelved off the market, right? So now you're dealing with new home inventory, and you're basically 1 million homes underserved right now the last 3 years. So there's 3 million homes right now in the market. So there's still multiple homes that are going in escrow, that are getting multiple offers. Trust me, my wife's a realtor, and we see the numbers all day long. So there are opportunities in the real estate market, but don't hold your breath. And if you see something and you like it, potentially thinking about what you can get it for. There's always a good deal, because this is a buyer's market. But at the same time, take a look at that. And don't hold your breath for a substantial 20-30% decline in the real estate market, because it potentially, because of inventory issues, shortage in homes, and people lacking to basically don't need to move, that could hold up the real estate market greater than one would anticipate. So the next slide we're going to talk about, this is very interesting. This is a slide that really plots the earnings. Now, what moves markets and keeps stocks moving higher over time is basically earnings or profitability. And how are companies, let's say we're going to go into a recession, we saw a negative and inverted yield curve, and all signs are now slowing down the banking sectors because of lending. Again, another reason why housing could do better, because lending is going to slow down. So there's going to be more even less people out there in the marketplace. So there's less supply, more demand of those who are actually looking. But at the same time, let's talk about the lines here. So let's get right here. In 2022, we're in the blue line right here. They're forecasting, or actually how earnings ended was $218 in the S&P 500. If you look at the earnings per share right now, they're forecasting, the red line is for 2023, how the S&P earnings will end up, which ultimately is an increase, not by much, but it's higher than we were in 2022. So there's profitability and there's earnings potential right there. But here's what's even more curious. This is 2024. They're close to $250 per share of earnings potential of the S&P 500. That's a substantial increase. Now they're even forecasting a 10% increase in profit margin for even a year and a half out. And that's what I said. The Fed looks through, the markets look through, what's happening. The Fed's going to be pushed on pause later this year. Even though there's an earnings or there's even a recession, corporations can work their way out of that. Now, how do we know this? This is another chart I showed earlier, but this is just showing that the blue line is the profit margins, estimated forward-looking profit margins, the S&P 500, and the red line is the unit labor costs, and what's what the Fed's focused on, bringing the wage inflation down. And once they bring wage inflation down, they can get a handle on what's entrenched long-term of inflation. So as these two diverge, that means that profitability could hold up for corporations, and margins can hold up and be sustained. And what's another factor here, Rob? Well, the unit labor costs also, cost of labor is going down potentially if this trend continues, because it's also forecast for 2024. So it's a forecast, but also what we're looking at in terms of big tech, every single one are laying off 10,000. It's almost like a daily, so who's going to one up each other? I'm laying off 10,000 here. I'm laying off 9,000 there. I'm laying off another 10,000 over here. Corporations are going to protect what this is their profit margins, and they're going to lay off. So as we've learned through history and through experience, that corporations will protect their bottom line, which is good for shareholders. And ultimately, that's how corporations weather the storm through a recession or even hard times, if you will. So markets are seeing through on the other side, and there's potential opportunity for earnings actually to do better and for corporations to protect their bottom line while we go through a recession. Who knows if it's going to happen later this year? Markets tell us they will. So let's get prepared for that. That being said, the last item for today, 7 o'clock tonight, I'll be on Street Signs on CNBC, so be sure to tune in, and that is Pacific Standard Time. So thanks again. Thanks for watching our market insights and observations, and we'll see you again next time. Take care.